Welcome, Dan. Thanks for joining us again for our July home buyer update. Again, we're with our friend, Mr. Tim Sisson. Sir, how's business going for you? It's the summer. Usually things are a little bit crazy. How are things looking for you?
We're busy right now, and I will say that there's no rhyme and reason to it. I just think that the stars have aligned. That a lot of the clients that I've spoken to over the last 6 to 18 months are, finally either ready to put their houses on the
Yeah,
market or they're just transacting. So yes, we're super busy right now. It feels good. Sometimes you get that summer lull. It didn't come this year.
it's true. No, I'm with you. June was a little bit slower than data wise. I looked back at my numbers. June is a little bit slower than usual, but the July is actually picking up. And then typically I have a pretty good August because people are trying to get it in before the school year starts.
Mhm.
But we'll see how that one goes. But yeah, I'm with you. Like all of a sudden got a little bubble here. A lot of people trying to do things. So
Yeah, a lot of home sale contingencies, which we'll talk about that a little bit later,
we
which
will.
it complicates things. But that's I think the most common buyer that I have right now is someone who wants to purchase that next house, but they have
Yeah.
one to sell.
Yeah, all right, well, let's do it. Let's talk about it. Like, we have some topics here today we're going to go over, and these are the questions and things that we're running into most. These are regional questions that are happening specifically in Southern Maryland. So if you're somebody looking in the area, these are really specific to our area, things I'm bumping into and you're bumping into. So let's just hop right into it. The first one is going to be rate buy downs. The rates aren't terrible, but talk to us about what rate buy downs are and when it makes sense.
So you have two different types of buy downs. One is a permanent buy down, and the other is a temporary buy down. So let's go permanent buy down first, which is just you're paying points, discount points, to lower your rate over the entire term of your note, and that is the most common type of buy down that we utilize. Which is, hey, I'd like to pay a point or a point and a half to get my rate 3/8 lower or 0.5% lower, because then my payment is that much lower for the full 30-year note. So that's very, very common. You can use seller concessions to do that. You can use your own money to do that. The other side is a temporary buy down, which we offer a 1-0 lender paid buy down, which is a 1 year buy down where your interest rate is 1% lower than market for that first year. So let's say rates are 6.5. Year one, your rate is 5.5, and your payment is based off of 5.5%. So it eases you into that payment. Same with a 2-1 buy down, which is 2 years. Year one, you're 2% below market. Year two, you're 1% below market, and then you go to full market in year three. Those are not as common, but if you can get the seller to pay for it, it's basically prepaid interest. If you get the seller to pay for a 2-1 buy down, it really allows you to ease into that mortgage payment. So, that payment shock isn't quite as much.
Yeah. So on my side, I really let you take a lot of the time on this one because this is really your area. And I usually just defer people back to you. But on my side, we do kind of build some of those things into an offer price. Like, hey, if you tell people, hey, a buy down of this amount would really be advantageous for you, then I talk to them about, all right, here's what the offer price needs to be. Maybe we bump up the offer price a tiny bit. So that way those sellers are more apt to say, oh, yeah, you know what? I'm paying a little more in closing help that the buyers can use for their buy down, and I'm getting a little more in sale price. And so on my end, I'm more reactive than proactive, and I hand them off to you. But there's lots of different things that a seasoned realtor like myself can actually build into these prices to make it a little more outside the box, a little less conventional, but really work for you in your situation. So that's my 2 cents.
I only really am a proponent of a 2-1 buy down if there's something that's happening in the next 2 years that is more transitional. For example, you do a 2-1 buy down, your rate is 2% lower than market in year one. In that time frame, is that going to help you pay your bills a little bit easier? Meaning, maybe you're floating 2 mortgages at the time. You have another house that hasn't sold yet. Is there a
Yeah.
car note that's going to be paid off in a year? Are you going to get a raise? Is there something happening? If none of that is true, and you're just like, hey, it sounds good to have a mortgage payment that's a little bit lower for year 1 and 2, let's do a permanent buy down in that scenario.
Yeah.
Let's just lower your rate for the full 30 years.
All right, so let's talk about that. So you say things that happen in the next 2 years. So I get a lot of people that are side hustling it, making some money on the side, making some extra funds and things, and that can actually play a factor in their pre-approval and the buy down. If they have a business that's starting to pick up some momentum and they come to you, how does that look? What do they need to be able to do or prove to use some of that side money?
So generally speaking, it's a 2-year requirement, and the reason is because underwriters they're smart people, and the people that create these guidelines, Fannie, Freddie, FHA, USDA, VA, they don't want to allow someone to use a second job for qualifying, because I could say, okay, you're qualified to 400. Well, what if I go get a job and get one pay stub, and then I could take you to 500? Well, is working two jobs actually sustainable for the long haul? And that's the real question. They want to see a bigger sample size that you can actually handle both of those jobs at the amount of hours that you're expecting. And once you hit that 2-year mark, I can use it for qualifying. So the second job stuff, we utilize it all the time. Someone is whatever it is. I think the most common I've seen actually is teacher and restaurant or food service, where they teach and they bartend on the side. And after 2 years, I can use that for qualifying. It's great. As business picks up, same deal. Self-employed, kind of want 2 years, bigger sample size. Over the long haul, what is the realistic qualifying income figure that we can use? So 2 years is kind of your gold standard.
And that's usually the exact same conversation I have with them as well, because you and I have had these talks before. So we've had this experience, and I usually tell them you got to have 2 years, got to have try to pay yourself along the way and try to show proof of income. That's the only way you can do it. But I try to get a lot of people to qualify without that extra income, because then it gives them a little bit of a buffer for those slow months or high electricity bill months, or I want to take a vacation months. And so I typically try to talk my people into spending a little bit less, or pretending that side money isn't even there when we go to make our offers on houses. But that's just me. I like to try to get people in great situations. Maybe they can make some extra payments. They can do some things with it, but I try to create some cushions for people. So if they're insistent, I send them back to you. But if they're not insistent, I love having that little bit of a buffer to help them even more.
It's the same with overtime and bonuses. If I could just qualify you on your base salary, that gives me a better feeling for you moving forward, that you're not handcuffed to needing to work 20 hours of overtime each pay period, or that, let's say your bonus is performance based, or it's discretionary, and all of a sudden it goes away. Base salary, I'd love to qualify everyone on just their base pay, and then everything else can just be gravy.
Yeah, so they go to Disney, like the Sisson family.
Yeah,
some Disney
that's
money.
right.
That's right. So another question I'm getting all the time is, when you're making offers, is it more important to have maybe some credit assistance, like some credits, or is it a lower price? Now, I have my opinion, but let's defer to you first.
I think seller concession all day long makes a lot more sense for most buyers, because the math is with rates in, let's call it the 6 to 6.5% range, the payment difference is normally about $6 per thousand. So let's use a $10,000 figure in price. The buyer is now saving $60 a month on their mortgage payment. Over the long haul, that's obviously a lot of money. Or $10,000 towards their closing costs now. In this day and age, buyers are feeling that pressure of needing the cash to close, or the closing costs, a little bit more than what $60 in a payment would do. That's a minimum payment on a credit card for most people. So I think that seller concession is a little bit more impactful. And then that client can still turn around and use that 10 grand towards buying down their interest rates permanently for 30 years. And it could be more substantial than $60 a month.
Yeah, I'm with you. So the Ben Franklin saying is 1 in a hand worth 2 in the bush, right?
Yes.
So you don't know where you're going to be in 5 years, 7 years, 10 years. Having that money now, you can do an improvement, or if something pops up unexpected, maybe a roof leak or something, it's nicer to have the money now. And then you can just plan on making some extra payments along the way. And I always try to talk them into doing something like that. We're like, hey, listen, if you really are strapped and want to offer less, it's fine. I'm pretty sure the credit's going to be more advantageous for you over the long haul. And you can even take some of those funds if nothing pops up and make an extra payment every year. Buy that thing down, move it down even better, because you're paying off of the interest. No, I've got it backwards. You're paying off the actual you're paying down the loan itself, not the interest, when you make extra payments.
That's correct. Paying down principal.
Stumbled on that a little bit, man. I don't know.
Well, if we're using analogies,
people.
They always say with the lottery, take the lump sum, right? So money now is more impactful than money over time. And of course, you just don't know how long you're going to hold that note anyhow.
Exactly.
There could be a refi opportunity in the future. You might sell that house in 5 years. That 10 grand, I keep using that as an example, but it's our example we started with. That $10,000 is so impactful for buyers right now. It really is.
Yeah, it really is. I'm with you. Now, we both have several clients right now that are trying to buy that next house, and they have a house to sell. We always talk to them about their options. They have bridge loans, they have HELOCs, they have some things. So talk to us about how it looks on your end and how you walk through the different options with them.
I think the most common conversation I'm having right now is the home sale contingent buyer and trying to mitigate that contingency. whether it be, borrowing against their current residence to then put down on the next residence. Now, if you're going to do that and take a second mortgage or a HELOC or something like that, you have to do it well in advance of wanting to transact. Like you almost would need to take it and keep it as a zero balance and kind of sit on it for a little while and then go to purchase that home, 5-6 months from now. We do have a great bridge product here at First Home that we can take some of that equity from the departing residents, put it down towards the new house. And then once that other house sells, that bridge pays off with the first mortgage. We have something called the golden ticket loan, which is similar to a bridge. It's very exclusive to First Home. It kind of acts as cash. And then you just have your sort of your standard, hey, can I get a gift from mom and dad? Buy the next house, as long as you qualify for 2 mortgages, buy the next house. And then once your house sells, you either reimburse them or what have you. So a lot of times when there's a contingent buyer, I'm giving them 5 or 6 different options.
Yeah, that's awesome.
Put the minimum down on the new house, let this other house sit. Let's just put 5% down on that. That house sells. Then you recast the new loan. That's another thing people don't know about. A recast is not a refinance. It's just pay down the principal, have the loan recalculated on the lower balance. Very creative stuff. We have so many different options. So I would say, more specifically than anything, if you're a home sale contingent buyer, a deep conversation, maybe even in person with your lender, is the most beneficial thing you can do.
With my 5 seconds, I'm going to say it is tougher to have an offer put in when you have a contingency than if you don't. And so odds are you're going to find a house you really love and someone's going to beat you out because you're not contingent. So have the plans and the discussion in place in advance. That's all my saying. That's my 2 cents.
And sometimes you have no choice. We go through plan A through D, and home sale contingency is just the only option. But we try to give you other options prior to that.
That's absolutely true. So the next topic I don't really want to talk about, but I think you and I getting in this question often enough that is something we're going to hesitantly take on. So the divorce situation, we've had a few divorces. I have a few other clients ask me questions. When it happens, what are the options? How does this discussion look for you?
So I think the most common, you have the splitting of the marital assets, sell the house, and each of them maybe go buy or rent to whoever they want. And obviously you being the agent who's going to be listing that property, that's a sensitive conversation to be had. Or one of them wants to keep that property and stay in place. And that's where I would come into play, which is buyout of the other individual. If that, let's say husband wants to stay, owes wife $100,000 per the divorce decree. We can actually do a refinance as long as they have the equity to do it. It's not a cash out. It's a rate and term refinance, because that $100,000, we almost treat that as a second mortgage to be paid out because we have a payee for it. The benefit to that is a rate and term refi has lower rates than a cash out refi. So a lot of times we're doing that equity buyout refinance, and it's actually a very easy process as long as you have that number that's specified. And then now federal law requires mortgage servicers to consider a mortgage assumption even on conventional loans. That used to be only FHA and VA, but in divorce situations, they have to entertain the request for an assumption. So then you'd call your servicer and say, I want to assume the mortgage and get the expense off of it. That is something that has come into play since October of 2025, actually. It's very new.
On my end, it's very systematic. I try to stay equal to both sides, over communicate. You have to go, all right, this is what the house is worth. And then you just have to go step by step. If you decide you want to stay, this is what it looks like for you. If you decide you want to stay, this is what it looks like for you. If you're going to split it 50-50, this is what it looks like for everybody. I just provide all of the different options, decide what you want to do. Here's the value. Here's the net sheet. And I'm just a data person at that point. And then once they've made their decision, then I can be a little more hands-on and helpful, but really just leaving it up to them, because I do not want to get too involved in that. And I want to over communicate. And I always tell people, like, if you send me any messages in a divorce situation, the other person will get that same message. Like, I'm not taking one side or other. Like, if you send me a text, I'm going to say, hey, listen, so-and-so just texted me. Here's where we're at. And just make sure I'm going back and forth, because communication for both parties is so huge in these scenarios, because both sides want you to know that you're on their side to help them, in which you are. It's just so delicate.
I think discretion is really important in those scenarios. Having been through many of those types of look, it could at the beginning it might seem amicable, and then it gets contentious, and
You gotta be careful.
you just need to have someone that's professional enough that has been through those types of scenarios before, that knows how to navigate and be sensitive to the fact that this is probably one of the most emotional times anybody can ever go through. And by the way, there's this marital asset we have to dispose of. That's where we come into play.
Exactly. Options and so forth. All right. Shifting gears to a little bit more fun. I would say fun. Fun is insurance. And we're bumping into a lot of people that are having issues with insurance. Not all the time, but once in a while, you'll have things like flood insurance that always comes up. I've had cases where things like branches over the roof have come up with insurance, and you have to take some branches down and things. I've had people that are like, hey, listen, we need to know what make and model the stove is because I want to see how old the chimney is. So when these things come up, how does that affect you on your end?
So first of all, the last few years, we've really bumped up the insurance piece of the PITI in our payment that we're sending to clients and what they need to expect. We've bumped it up considerably. I would say even really, it started with supply chain issues. Let's call it COVID 2020. Supply chain issues means lumber's more expensive, labor's more expensive. It's more expensive to rebuild a house. So prior to that, on a $400,000 house, I might estimate $1,200 a year for insurance. That is probably up 4x from what it was back then, because it's more expensive to build a house. Also, these insurance companies have paid out a lot of claims from natural disasters over the last several years, fire, floods, hurricanes, that kind of thing. And the roof replacement, I'm not going to say epidemic, but a lot of people are doing it and they're claiming it against their insurance. They're filing that claim and trying to get a roof replacement for free. So what happens now is someone's purchasing a home, they call to get an insurance policy. The first question they ask, how old's the roof? Period. Because if it's on its last legs, they are almost expecting that they're going to file a claim for it. So they boost their premiums up. I'm going to be quick on this last piece. You and I had a client several years ago that had their insurance canceled 2 weeks after they closed.
Yes.
One of the biggest insurance carriers in this country gave them a policy. We closed with it. They did a drive-by after closing and said, we don't like that tree's too close to the house. We're canceling your policy. And then they're scrambling to get one. So I think similar to you and me, and we're doing things locally, local insurance agent, big benefit to that.
Yeah. Yeah. So that's very tough. And so and they're not allowed to really talk to the home inspector. There has to be a disconnection. They can't really say, hey, show me the reports. If you have an insurance person that's saying, show me reports, that's a yellow, not red, but yellow flag. We're like, I don't know if I like that idea. Like, you need to do your own policies, you got to do your own stuff. But yeah, so I'm with you. Try to use locals the best you can. If you're using a big name carrier, I always, when I walk around houses and I'm showing them, I look at branches. I look at the stuff that I've seen over the years. We make sure we do kind of a home inspection with a fireplace if there is one, in case it comes up. All those things I've come across and all those things I'm leery of, and I have those discussions as we go. Does that make it foolproof, like that the insurance company always goes with us? No, not always, but at least we've had talks along the way and we kind of prepare them for it. So it's an intangible, but for the most part, you and I kind of cover our bets and educate our people as much as can, but be on the lookout for sure.
I've had more conversations regarding coverage than price over the last several years, because I don't want my clients to just go to the lowest bidder, the cheapest premium out there. I want them to make sure they have good coverage too. Because we've seen the price pales in comparison to what forced coverage would be. If you this is something that people don't really know. If your insurance drops you have 30 days to get a new policy. Sometimes in that meantime, like, you don't open your mail or you don't realize how the levity of the situation. Forced insurance from your mortgage company is very expensive. So let's make sure you have good coverage. Let's make sure that insurance company did their due diligence up front, that they're not going to drop you later.
Yeah, that's good. That's good. All right, so we're going to end on our fun. Our fun is that the Calvert Marine Museum just finished up their Shark Week. My daughter loves sharks. I don't know why. She's a big Jaws fan. She's always been a Jaws fan. So it just kind of reminded me of some of the fun things that happened around here this summer. So I was going to ask you, what are some of the fun things locally that you and the family have been doing this summer?
Well, we always follow Jefferson Patterson Park. They always do fun events there. They had the sort of day on the farm, always go to the touch of trucks at the schools and things of that sort. I think that Southern Maryland, there is really a lot that goes on in the community as long as you follow the right, pages on social media
Mhm.
and things of that sort. Especially during the summertime, there's so much to
Yes.
do. If your kids are sitting around bored, that might be on you because you didn't do the research, because there's so much to do. I love living here. I love raising children here. There's always something to do. And we didn't make it to Shark Fest. My nephew went. It looked
Yeah.
very, very fun. But it makes it easy to parent a kid in Calvert County during the summer when they are off school, because there's always something going on.
Mine are a little older than yours, so we're now in more of a farmers market phase, and there's people are always shocked about how many farmers markets we actually have around here. Mine are like, hey, let's go to get some good food and come home and cook it. Like both of them like to cook and do things, and so we go to like farmers markets, and there's so many like spots where you can pick up baked goods and things like that. You can try out new stuff, and so that's where we are, because there's a lot of farm to table style food compared to most areas. Like, I was showing some houses in Tacoma Park, and I was talking to them about like, hey, we have a farmers market here and here, and they're like, we don't really have any here in our area. And I'm like, what? That's crazy. Like, well, you've got like 6 or 7 farms down there. I'm like, yeah, you know what? We got a handful. That's right. I didn't even think of that, but so much fun
We
stuff.
we went strawberry picking, I think, twice in 10 days earlier this summer. It
Yep.
was around May, because I think it was around Mother's Day. We went down to Linda's greenhouses. We love
Yeah.
Jake's off of Brooms Island Road. It's one of the farm
Yep.
stands. I mean, there's several of them, but we love that. And then we went to Swan and picked
Yep.
strawberries. My kids love picking strawberries.
Yep.
There was a little bit of a drought, and I was reading online that they were worried about the strawberry crop, and I tell you, they were delicious. They were awesome.
Yeah, they're awesome. Yep.
Yeah, there's a lot of agritourism in Southern Maryland,
There
as
is.
you'd expect, and all the kids love it.
They're of the age where we try to get them to do a little more hiking, because there's a lot of fun hiking. We do get them to Jefferson Patterson Park, like your kids, pretty frequently, but it's mostly like farmers markets and food and trying out new foods. That's really where for
Yeah.
our age, our meat is.
My
So.
oldest loves Calvert Cliffs and Flag Ponds. Loves loves that kind
We
of
have grumpy teenagers, man. It's tough because getting them out of that and doing all the white hawking and stuff like that, it's tougher. But if you can promise them food and stuff at the end, or stop by and get some ice cream somewhere, then you can talk them into a few more things.
It'll be nice in a couple of years when that water park is back open. I'll just leave it at that. My son, we drive by it all the time. He's like, Dad, when it's going to reopen? I said, I don't know, buddy. They're working on it.
They're working on it. Awesome. All right. So thank you for another awesome July. That's where the buyer's market, keeping you educated on Southern Maryland. So those are our topics, the things we're coming across the most. And if we didn't cover a topic that you want to know more about, it's easy to get a hold of us. We're both on social media. We're easily searchable. Tim is at loanswithtim, right? .com.
That's true.
Okay. See, I've been paying attention. And BillySammons.com. So we're easy to find. We're all over the place, social media, websites, our phone numbers are everywhere. So if we didn't cover something that you need more information about, just reach out. We'll help you.
Thanks for having me again, my friend.
Awesome.